time for sharing his knowledge. Ali, over to you.
Thank you. Hello, everyone. I've been told that the session, the attendees are pretty much from all over the time zones. So I'd like to say good morning, evening, afternoon to whatever applies to your situations. Before I start, a big thanks to Excel Advise and Rodin Surani for inviting me for this webinar. I think they're doing a great job, and I hope they continue doing it. As the motto says, keep sharing, keep learning. As the audience is very international, the mode of delivery will be in English, and I hope that it suits all the attendees. Ratios is a very vast subject in itself, so obviously we would not be able to cover all of it in 1 hour. What we'll try to do is we'll pick the important ratios and we'll try to discuss them. And you know, since we are short on time, so some of the attendees might feel that I'll be you know, running through the session and the pace will be fast. So if at any point in time you feel you're lagging behind or you have any questions to ask, you can always press the raise your hand button, or you can write your comments on the comment box. So I'll try to answer you know, either between the session or at the end of the session. So let's start. To start off, I'd like to give a brief introduction about myself. I'm currently working as a CFO at KIA. It's a leading company in Pakistan. I have had experience in various roles in the banking department. I have been an FX trader, a treasury economist, an equity research analyst. My academics include 2 masters, MSc in finance and investment, and an MBA, and I am CFO level 2 pass. Teaching experience includes various seminars where I have taught people from pretty much all kinds of industries. So yeah, that's a little about my experience. So before we start, you know, we will let's see what we will cover today. We will cover major financial ratios and try to understand what each ratio tells us about the financial health of a company. Ratios which we will cover today are as follows. We'll start off with profitability ratios. We'll do net margin, gross margin, return on equity. Then we'll move on to liquidity ratios. We'll do current ratios, asset test ratio. We'll move forwards to leverage ratios, and we'll cover debt to equity ratio and times interest earned ratio. Then we'll do efficiency ratios, inventory turnover, accounts receivable turnover, and in the end we'll do market ratios, which are very important. It's a very diverse subject in itself, and we'll only cover price to earnings ratio. In the end, we'll spend some time trying to see how to apply what we've learned in Excel, since this is an Excel group. So we'll learn to make a ratio dashboard on Excel. I'm told my screen is paused. Okay, can anybody confirm if they can view the screen moving?
We are unable to see. No, we are unable to see.
You can see the screen, right?
Your screen is paused. Your screen is pause mode, I think.
Okay. Sorry?
Screen is in pause mode. I think it is pause mode.
Okay, is the screen moving now? So yeah, I think the screen is in play mode now, so we'll continue.
Yeah.
So before we start, it's important to note that ratios in itself are just formulas and they mean nothing. So what we need to do is we need to compare ratios with industry averages and do peer analysis. So you know, to get some meaning to the ratios in itself, as it's written, is just mathematical formulas. Ratios can also be used to do cross-period analysis. For example, if we are analyzing a company's profitability over a period of 5 to 10 years, we can use various ratios to see how the company has progressed over a period of time. So ratios are a good tool for cross-period analysis as well. Again, ratios should be looked in perspective of company and industry dynamics. Various companies are at different stages of their life cycle, for example, if a company is just starting off, generally a starting company has high costs and hence they have low profitability. So such a company might show low profitability ratios, and that wouldn't mean that the company in itself is not doing very well, but it's more to do with the company's stage in the life cycle. As the company grows, from initial stages, the company moves on to the growth stage. At this stage, the profitability ratios increases, and so does the cost, and the cost decreases. And we also know that leverage ratios will also start improving at this point in time, because the company will start pretty much paying off its debts and will get in a more comfortable position. So going forward, the company moves on to its peak, to mature stage. The mature stage, the company has pretty much peaked its profitability, and the company is a pretty stable company at this stage. And in the end, when the company's life cycle turns into a decline stage of the life cycle, the profitability again starts to dwindle. So it's very important to know what stage a company is in its life cycle, and also we need to understand the industry dynamics, as different industries have different tendencies, and the ratios might be affected by these industry dynamics. We'll learn pretty much about it as we move forward. So we'll start off with profitability ratio. Profitability ratio, as the name suggests, these ratios are used to analyze a company's ability to generate earnings as compared to its expenses and other relevant costs. Obviously, higher profitability ratios compared to peers are generally good, but though that is not the case in all situations. We'll see which situations are such as we go forward. Analyzing state of the company's life cycle, industry life cycle, is also important, as I just mentioned. And also, it's always it's important to be aware of one-off events. There are many situations where a company's 1 year profitability might jump substantially. That can be due to a one-off event. For example, if a company sells a huge chunk of its fixed asset, the company would show a huge earning jump, and that might result in a higher profitability ratio. So it is always advisable to use an average of a period of 5 to 10 years to see how the company is doing. So or either that, or one should just take off the one-off event from the financial statements and do the ratios without that one-off events. So the first ratio we'll do today is profit margin. Profit margin is calculated as it shows over here. It's net profit divided by net sales, and since we will turn it into a percentage, so we're going to multiply it by 100. So this is pretty much the net margin ratio. The ratio tells us what percentage of sales is left as net profit. So basically, when a business starts selling, that's the basic raw revenue, and then there are costs which the business earns, and in the end, the business left with net profit. So pretty much the net margin tells you what percentage of the profit is left out of the initial revenues. Higher the ratio compared to peers, the better it is. Some industries have very low profit margins. These include highly competitive industries or industries with high volumes. For example, airline industry. Companies relatively new can have higher profit margins because they just started to grow, and hence they can have higher profit margins. A company with a higher gross margin, net margin, may turn out to have a lower net margin due to higher, again. Now we'll see what this means as we move forward. Basically, what I'm trying to say is that the important thing which we need to know is, as I mentioned earlier, different industries have different dynamics. So some industries are prone to have lower net margins. For example, airline industry, because these industries are huge volume industries. The earnings, most of the earnings come through the volumes and not the margins. So these companies are such an industry in itself has lower net margins, but that does not really mean that the company is not doing well or the industry is not doing well in itself. Let's see an example. For example, company A, we have two companies over here, company A and company B. Company A has a net profit of $200 million and sales of $1 billion, while company B has a net profit of $400 million and sales of $4 billion. Which company is better? So for company A, the net margin would be 200, which is the net profit, divided by sales of 1 billion. The profit margin or the net margin is 20%, and while for company B, the net profit is 400 million divided by 4 billion of the sales. So net margin is 10%. So we see over here that for company B, though the profit is much higher than company A, company B's profit is 400 million, while company A's profit is 200 million, but the net margin for company B is much lower compared to company A. Hence, just on net margin basis, the company A is better. So what basically this ratio tells us is that it common sizes the net margin number. So basically, it compares two companies with different profitability levels, but it tells us which company is more efficient based on its sales. We move forward. Next ratio we cover is gross margin. Again, gross margin is calculated by
Ali, we are unable to see your entire screen. Can you? I believe that if you out from the play, if you press escape, I believe that your screen will be displayed.
Escape. Can you see it now?
Yes, similar.
Try to make as a screen full screen.
I'm not there.
I believe that if we can zoom out.
I have actually zoomed out. It's not zoomed out.
It's okay. If you zoom out a bit, your screen, the presentation side.
I have basically it's a normal view. It's not
Please try in your show my screen tab, click on entire screen, not in PowerPoint.
Yeah, I've clicked the entire screen. All right, so we'll continue. Next ratio we cover is gross margin. So gross margin is basically gross profit divided by net sales into 100 just to get to the percentage. The ratio tells us what percentage of sales is left as gross profit. So basically, gross profit is pretty much sales minus cost of goods sold. It's important to remember that gross profit margin can vary drastically from business to business and from industry to industry. For instance, the airline industry has a gross margin of about 5%, while a software industry has a gross margin of almost 90%. These are average ratios. So again, as I mentioned earlier, different industries have different dynamics. So these ratios can vary drastically amongst industries. Also, highly competitive industries have lower profit margins, which basically includes the net margin and the gross margin. So since in industries where there's high competition, obviously such industries have very low margins. And in such situations, as I mentioned earlier, the best tool is to analyze the companies with its peers or industry averages to see how the industry is doing compared to its competitors. We should not generally compare a company in a certain industry with a company in a different industry. So we move ahead. We have an example which will further elaborate what I'm trying to say. So let's do an example. For example, company A in a software industry has a gross profit of $20 million and sales of $30 million, while company B in the airline industry has a gross profit of $500 million and the sales of $5 billion US. So which company is better? Company A's gross margin comes at 67%, and we divide the gross profit by sales, and for company B, the gross margin comes at 10%. Again, in this situation, we cannot tell which company is better because both companies are from different industries. So what we need to do is we need to analyze both these companies with their peers, with their industry averages to see whether the companies are doing well or not. We move ahead. Next ratio we'll cover is return on equity. Return on equity is one of the most important ratios, as it tells what return one has generated on the equity or investment in a business. So basically it tells us if we invest for let's say for example a certain amount of money in a business, it tells what percentage of return are we getting on that investment. So there are many ways to calculate ROE. The simplest is that we divide the net profit with net equity. Generally higher ROE is better. However, in some situations higher ROE does not exactly mean that the business is doing very well. For example, if a company is highly leveraged, the ROE will be high, but that does not mean that the company is doing very well. Because what we're doing is we're dividing net profit by equity. In such situations, the company's debt will be very high and the equity will be very low. So since the denominator is low, the ROE ratio will be showing a very high number. But the company is highly leveraged. So in such situations, we need to use return on assets rather than return on equity for such companies. Further analysis will be required in such a scenario. High growth companies have high ROEs. Average of 5 to 10 years should be used to draw conclusions. Again, as I mentioned earlier, in certain situations, companies have one-off events when a certain year would show a very high profit, and that will not be due to the normal activities of a business, but the business might have had an unusual scenario where the business sold a part of its fixed asset, or the business got a huge return on its investment. So those are not normal scenarios, and in such a scenario the company might show a very high return on equity number for a certain year. So it is always advisable to compare, to have an average of the return on equity over a certain period of time to see if the company is doing well or not. There's another way to calculate the return on equity ratio. It is called the DuPont analysis. DuPont analysis is pretty much a mathematical breakdown of return on equity. What it does is that it breaks down return on equity into 5 different ratios. The first ratio is net income over pre-tax income. That we multiply it by pre-tax income over earnings before interest and taxes, and multiply it by earnings before interest and taxes divided by sales. Then it's sales divided by assets, and in the end assets divided by equity. So basically, it's pretty much a breakdown of the same ratio return on equity. It's a very vast topic in itself, and we'll need a whole session to go about it. So I'll just leave DuPont analysis over here for the time being. We move ahead. We move to liquidity ratios. Liquidity ratios are used to determine a company's ability to pay off its short-term debt obligations. Generally, higher the value of the ratio, the larger the margin of safety that a company possesses to cover short-term debts. Basically, all companies need liquidity to operate. Liquidity means, in its simplest term, is basically any asset which can quickly be converted into cash. So to run a business, everybody needs a lot of cash to be able to meet everyday costs and then run the business efficiently. So liquidity ratios sees that what amount of liquidity or cash can a company generate in a certain situation, and also analyzes that with the company's short-term obligations, short-term liabilities, and basically these ratio tells us that how much cash the company has to meet its short-term obligations. The first ratio in liquidity ratio which we'll cover is current ratio. The current ratio is calculated by dividing current assets over current liabilities. The ratio tells us how equipped a company is to meet its short-term liabilities through short-term assets. So I hope everybody knows what short-term assets and short-term liabilities are. The short-term assets are basically the most liquid form of assets a company has, and short-term liabilities are all the obligations and liabilities which the company has to pay off in a certain fiscal year, basically mostly in 1 year at a time. A ratio under 1 for current ratio suggests that the company would be unable to pay off its obligation if they came due at a certain point in time. Basically, if there are higher short-term obligations than short-term assets, it basically means that the company would not be able to pay off all its obligations. That's what the current ratio tells us. We need to analyze all the heads under current assets and current liabilities. Some companies have high inventory levels or high receivable levels, which might show a very high current asset number. But in these situations, though the ratio might be very high, the current ratio, but all the assets, all the heads under current assets are not easily convertible into a cash. So further analysis is required in such situations. Next ratio we'll cover is asset test ratio. The asset test ratio is pretty much the current ratio, but the only difference is that we take out inventory from current assets before calculating this ratio. Because it is assumed that if a company has to face a distress situation, the company would not be able to quickly convert its inventory into cash. So it is advisable, or it is just wise, to take off the inventory from current assets and see what the ratio comes after it. Again, if a ratio is below 1, it basically means that the company is not well equipped to meet its short-term obligations. If the asset test ratio is much lower than the current ratio, it would also mean that current assets are highly dependent on inventory, which is obviously because the current ratio we include inventory, and in asset test ratio we take out inventory. So if our asset test ratio is very high, but the current ratio is low, if a current ratio is very high and asset test ratio is very low, it will tell us that the company is highly dependent on inventories, or the company's sales are not as quick as it should be, so the company is not able to clear off its inventory position efficiently. Some industries again naturally are prone to high inventory levels and hence would have low asset test or current ratios. Sorry, it's not asset, it's current ratios. Such industries are retail chain stores. We move to an example. Okay, so we don't have an example for liquidity ratios. We move to leverage ratios now. Leverage ratios help us analyze a company's ability to pay back its liabilities, or in other words, it basically shows a company's leverage levels. Leverage basically means the amount of debt a company has borrowed. Obviously, a company finances its business through two portions. One is equity, and one is equity, and one is debt. So the equity is the cash or the investment which the company has put from its own pocket, and the liabilities or the debt portion is the company's is the portion which the company borrows from others to finance its business. So the leverage ratio basically tells us what amount of how efficiently the company is managing its finances, whether the company is highly dependent on money from other sources, and would in a distressed situation company be able to pay off these obligations. Again, these ratios vary from industry to industry. Certain industries are prone to have high leverage levels and high debt levels, and again the conclusions can only be met by comparing industry to its competitors or to the industry averages. The first ratio we cover is debt to equity ratio in leverage ratios. Debt to equity ratio is calculated by dividing total debt over the equity. Basically, it means that how much more debt the company has taken compared to its equity investment. How much more, how much less. A ratio above 1 would tell us that the company is more leveraged, which basically would mean that the company has borrowed more to finance its business compared to its own investments. The high ratio would suggest that the company has aggressively borrowed to finance its growth. This can result in lower profits due to high interest cost. Obviously, when you put your own money in the form of equity, you do not have to pay any interest on it. But when you borrow money from others to finance the business, you have to pay a cost on it. So high leverage would mean that you would have to pay higher costs, higher interests to finance that business. However, some leverage is always beneficial. As long as the interest cost of borrowing is less than the return on equity, debt adds value. Now, this is a very interesting subject, and basically what it tells us is that generally debt is not always bad. As long as the cost of your debt is lower than the return you would earn from that money, the debt is good. But at the point in time when the cost of your debt starts becoming more than the return you can generate from it, the debt becomes bad for the company. We'll do an example to more clarify the scenario. A company can earn, for example, let's say 20% return on equity from an investment, and this venture needs an investment of $100 million. The company can borrow at a rate of 19% up till the debt to equity ratio is 1, after which the borrowing costs would start increasing. The company will be better off borrowing 50 million and investing rather than investing the whole 100 million in the business. Now let's see how it will happen. For example, if the company invests total 100 million from its pocket, the return on equity the company would generate is 20%. Hence, at the end of the year, the company's return would be $20 million on $100 million investment. But on the other hand, if the company borrows 50 million and invests 50 million from its pocket, the return will be higher because the company will earn a 20% return on the 50 million it has invested from its pocket. Hence, the return on its own investment will be 10 million. But the company will also earn a 20% return on the borrowed money. However, the company would have to pay off the interest cost, which is 19%. So the company would earn 10 million from the borrowed money, but will pay off the interest as 9.5 million. The company will be left with 0.5 million additional amount of profit. Hence, the total return in this situation will be 10.5 million divided by 50 million, which is 21%. So we see over here that if the company, since the company has leveraged itself, it has used others' money to finance its business. The company has been able to generate a higher return on equity compared to a situation where the company would have invested only from its pocket. So that is not always bad. That is good as far as the cost of debt is lower than the return on equity which the company can generate. I hope everybody is on the same line. If you have any questions, you can always type the questions to let me know, and I'll be most happy to go back to any slide and further explain. Next leverage ratio which we'll cover is times interest earned. The times interest earned ratio is calculated by dividing earnings before interest and taxes by total interest expense. Basically, it tells us what amount of profit the company is earning before paying its taxes and interest, divided by the interest expense. So it tells us how many times that profit is to the interest expense. So it is also called an interest coverage ratio. High ratio would suggest that the company has low interest bearing debt, or either the company's profitability is very good. Point to note over here is that companies at an early stage or high growth phase may have high borrowings, and hence in these situations the company may show low time interest earned ratio. But again, this doesn't mean that the company is necessarily doing badly or poorly. There can be phases where the company has high debt, and in such situations the company's ratios, the interest earned ratio would be very low. But again, we need to know the full perspective about the company, what stage the company is in, and how the company is progressing. So again, in such a situation, taking an average over a period of 5 to 10 years is advisable, or to see company's future expectations. If a company is going on an expansion and have borrowed heavily for the time being, the interest coverage ratio might be low for the time being. But once that expansion kicks in and the profitability increases, this ratio will settle down at a lower level going forwards. Next, we move on to efficiency ratios. Efficiency ratios are used to analyze how well a company uses its assets and liabilities internally. These ratios are great tools to analyze a company's management's performance against peers, because efficiency ratios, if there are improvements in these ratios, indicate efficiency and have a direct impact on profits. So it basically tells us how the management is managing the company's assets and liabilities, how well the company is using its resources. We'll see examples as we move forward. The first efficiency ratio which we will cover is inventory turnover. Inventory turnover ratio is calculated by dividing sales by inventory. Ideally, we should use average inventory because there can be cyclical impacts on inventory. So we should use average inventory, which is basically opening inventory plus closing inventory divided by 2. The ratio tells us how many times the company has been able to sell its inventory over a period. Average inventory is used to adjust to seasonal factors. A low turnover implies poor sales and therefore excess inventory. Inventory are no return assets. So basically what this implies is if a company has a very low inventory turnover ratio, the company has high inventory levels. And inventories are not, they do not pay any return, unlike short-term investments or cash which is put with a bank. These short-term investments or cash would earn a certain amount of return, but inventories would not. So, so if a company has high inventory levels, it is generally assumed that the management is not efficient enough. They're not managing the inventory levels efficiently. However, a very high ratio either though a very high ratio can imply strong sales or ineffective buying also. A very high ratio can also mean that the inventory levels are very low, and which can basically mean that a company is not able to provide the goods to its buyers at a certain point in time. Again, these ratios should be compared to industry averages. For example, if a company has a very high inventory turnover ratio, but the industry average is much lower, this will tell us that the company's purchasing is not very efficient. The company is not maintaining sufficient amount of inventory levels at all times. So again, it shows that the company is not doing very well. So basically, a very high or a very low ratio both indicate that the management is not efficient enough in managing its inventories. Next ratio is accounts receivable turnover. Account receivable turnover ratio is calculated by dividing sales over accounts receivables. Again, we should use average account receivables. The ratio tells us how efficiently a company manages its receivables level. Again, account receivables are assets, but basically they are the funds which are due to be received from customers. Once we have made a sale and we haven't received the money from that sale, such amounts are called as account receivables. So if there are high account receivable levels, it basically means that our customers are using our money to finance their operations. But however, a low turnover implies poor receivable management, meaning the company is lending interest-free credit to its customers. Some industry norms are of long receivable periods. Hence, the ratio should be only used to compare with peers. Again, in certain industries, the receivable policy is much more relaxed, and in certain industries you would expect to receive your proceeds from sales in, let's say, a period of 2 to 3 months, which is pretty high generally. But for some industries, it's just a norm. So again, it is important to analyze these ratios compared to the competitors or industry averages. We move on to market ratios. Market ratios are a very vast topic in themselves again. So we would not cover many market ratios. We'll just do one of the most important one, which is price to earnings ratio. Market ratios are generally concerned with the relationship between return on the value of an investment in company's shares. Market ratios are important tools to forecast fair value for investment. The ratio which we cover is price to earnings ratio. So basically, price to earnings ratio is calculated by dividing market price of a company by the earnings per share. Using EPS of past 12 months would give us a trailing price to earnings ratio, while using forecasted earnings per share of the next 12 months will give us a forward PE ratio. Price to earnings ratio is only useful when compared to the industry or the market in general. A low price to earnings ratio compared to industry or market will mean that either the company's share price has a room for growth or the company is not doing very well. And similarly, if the price to earnings ratio is much higher than the industry average, it will also mean that the company, the share price of the company might fall going forward. So this is pretty much it about the ratios. What we'll do now is we'll do an example and see how to make a ratio dashboard in Excel. So for example, if you
prefer, there is a question from Munawar sir.
Yes,
should I send it to you?
Yes, please.
I'll Skype you the question if you can please answer the question. Or you can click on the question mark at the right of the.
Okay. Okay, so I have a few questions from Noor Hussain. The first question he's asking is, if we have to pay dividends, would that still mean that debt is cheap? So generally when we pay dividend, the dividend expense is counted in the net profit. So if and we calculate return on equity based on the net profit. So obviously the dividend expense is taken into account to see the return on equity. And if after taking into account the dividend expense, if the return on equity is higher, it would basically mean compared to the cost of borrowing, it will basically mean that the debt is good for the company. Other question which Mubashir Ahmed asks is, what should be ideal number of years to take average of accounts receivables? Inventory or whatever the actual account balance is. Generally, what we should do is that for accounts receivables, we should divide the opening accounts receivable plus the ending accounts receivable by 2. That for that particular year, this is how we should do. We should not try to go back very far, let's say in time, because there's always a recency effect. So for the ratio in itself, to calculate the receivables turnover ratio, we should do sales divided by opening account receivable add ending account receivable divided by 2. But we should compare these ratios over a period of time. So once we have the ratio for a particular year, we should see similar ratios for the past 5 or 10 years, and we should see the trend. If there is a certain year where the ratio is much higher or much lower, that year needs further analysis. As I mentioned earlier, that can be due to a one-off effect. I hope that clarifies your query. Next question is from Rahim Zulfikar Ali. Says, as financial ratios are like gems for any kind of data to do data analysis, what can be some financial ratios for contact center of a bank for analysis and monitor the performance? If you can, okay. So obviously, contact centers are a different type of business altogether. They are more service oriented. There are many ratios again which you can generate for contact centers. What I can do is I can send you by email a whole list of ratios which you can use for contact centers. But generally, you can the most easiest ratio would be if you have access to data to see that how many calls contact center has used to generate let's say an account. For example, if there are 10 calls per account opening, so you can see how many calls a contact center needs to open an account. Again, that is just one ratio. There are many other ratios which can be used. I'll be most happy to send you through email. So if anybody else has any other question, we can take those questions now, or we'll move on to the example on Excel. Okay, so we'll move to Excel now. So I made this a sample company called XYZ. So we have the company's profit P&L statement over here for 2013. The company's sales, let's assume, were $20 million. Cost of goods sold $15 million. Gross profit $5 million. Admin expenses $2 million. Earnings before interest and taxes $3 million. Financial expenses $1 million. So the earning before taxes comes at $2 million, and let's say a 40% tax rate. So $800,000 is taxes, and the net company's ending profit or the net profit is $1.2 million. We have company's balance sheet over here. So I have posted 2 balance sheets. That is for the year 2012 and 2013. And again, I'll share this example with Nurdin Surani, and he can always email it to you, so you'll have access to this example as well. So here is a ratio and a dashboard for ratio analysis. So before we move on, let's assume that the outstanding shares for the company are 1.5 million, and the current share price of the company is $10. So first we'll do the profit margin ratio. So to do the profit margin ratio, we'll link the net profit and sales. So we'll press is equal to sign. We'll go to the profit and loss sheet. We'll click on the sales tab. We'll press the divide button. We'll click the net profit tab first. Is equal to going to the profit and loss sheet, and net profit divided by the sales tab, and we press enter, and we'll change it to percentage. So the profit margin for this company for 2013 was 6%. I have written down industry averages also over here, so we can see the industry average was 5%. So basically the company is doing well, and it has a better profit margin compared to the industry average. Next we'll do the gross margin. Again, we press is equal to, we'll link the formula, we go to the profit and loss sheet, we click on the gross profit tab, we press the divide button, and then we press the sales tab. So the gross profit for the company is 25%, but the industry average gross margin is 28%. So again, it's an interesting scenario. The company has a better profit margin to it compared to industry, but the company has the lower gross margin. So what this tells us is that the company has high administration expenses. It can be either high admin expenses or high borrowings, so hence high financial charges. So something wrong has happened below gross profit. Something wrong has happened. Something wrong has happened between sales and gross profit. So the company has a lower gross profit. So rather this company, rather than saying high admin costs, this company actually had high cost of goods sold. So something wrong happened between sales and gross profit. So we can assume that the company had higher cost of goods sold, hence lower gross margins, but better administrative and financial expenses, lower better expenses, so higher net margin. Next ratio we should do is return on equity. So for return on equity, we press is equal to, we go on the profit and loss sheet, we click the net profit tab, we press the divide button, then we go to the balance sheet tab, and we go to equities, which is over here. So we press shareholders equity and press enter. So the company's return on equity is 3%. The industry average over here is 2.5%. So again, return on equity is better compared to the industry average. We move to the liquidity ratios. For current ratio, we know the formula. It's current assets divided by current liabilities. So we press the is equal to button. We go to the balance sheet and we go to current assets, which is over here. So we click current assets and we press the divide button on the balance tab. So the current ratio of the company is 1.87. Again, the industry average is 1.0. Is better equipped to deal with its short-term obligations compared to the industry. For asset test ratio, obviously we know the formula. It's current assets minus inventories divided by current liabilities. So we press is equal to button. We make a bracket to subtract the inventories. We go to the balance sheet tab. We click on the total current assets. Then we subtract inventory from it. Bracket close, divided by current liabilities. So the asset test ratio is 1.4, but the industry average is 1.6. So this basically implies that the company has higher inventory levels compared to the industry. So basically what this means is that other companies in a similar industry are doing the inventory management much better. we go to the leverage ratios. First ratio is debt over equity. So we press is equal to button. We have to choose all the interest-bearing debt in the balance sheet. So that will include the long-term debt, the short-term debt, and we would also add the current portion of long-term debt, which is shareholders' equity. The ratio is 0.61. The industry average is 0.8. So it basically means that the company has less debt compared to the industry. We can say the company is not as leveraged as the general industry is. The next ratio is times interest earn ratio. So time interest earn ratio is we press is equal to button. The formula we know is earnings before interest and taxes divided by the interest expense. So we go to the profit and loss tab. We click on the earnings before interest and taxes tab. We divide this by the interest expense or the financial expense, and the ratio which we come to is 3 times. So it basically tells us that the company's earnings before interest and taxes is 3 times its interest expense. So the company can bear its interest expenses pretty easily. It's pretty comfortable to pay off its interest expenses for this year. The industry average again is 2.5. So it shows that the company is less leveraged compared to the industry. Next is efficiency ratio. The ratio is inventory turnover. We know it's sales divided by average inventory. So we press is equal to. We go to the profit and loss sheet. We click on the sales tab. We press divide button. We'll open the brackets to take the average of the inventories. So we move to the balance sheet and we go to the inventories tab. So we click on the inventory for 2012. We add inventory for 2013. We close the bracket. We divide it by 2 and close the bracket again. So we get an inventory turnover of 4.2 times. However, the industry's average inventory turnover is 6 times. So basically, it means that this company is turning over its inventory much slower than the industry. So the company's management is not efficient enough to regularly sell its goods in this situation. Next ratio is accounts receivables turnover. So we press again. We know the ratio is sales divided by average receivables. Press is equal to. Go to the profit and loss sheet. We click on the sales tab. Divided by. We'll open brackets to take an average of accounts receivables. So we click on the account receivables for 2012. We add it with account receivable 2013. Close bracket. Divided by 2. Close the bracket again. And we get an accounts receivable turnover of 7.1. Again, the industry average is 11. It tells us that this company is not efficient enough in receiving its receipt is very lax, receivable policy, or the company is not efficient enough in just receiving its money in time. In the end, we go to the price to earnings ratio. So price to earnings ratio, it's basically the share price, the market price divided by earnings per share. So we know the market price is $10 as it's mentioned at the top of the sheet. So we click on the market price. We divide this by we'll open brackets to get our earnings on per share basis. We go to the profit and loss tab. We click the net profit, and we divide this by the total numbers of shares outstanding, which again is mentioned on the ratio dashboard sheet, which is 1.5 million. We click on it, we close the bracket, we press enter, and we get an price to earnings ratio of 12.5. So this basically tells us, compared to industry, which has an average PE ratio of 20, it tells us that the company's share price has much room to catch. So either that or either the market expects the company to underperform in the future. So that's pretty much about it. We have created the ratio analysis dashboard. If there are any further questions, I'll be most happy to attend them.
Thank you so much, Ali, for spending time for discussing the ratio analysis with us. And thank you all of you for attending the webinar. See you next time. Okay, thank you. Bye-bye.
Thank you. Bye.